Hi friends, Chitra here. Welcome to my YouTube channel. Today we are going to learn what are the products in the Indian derivative market. So we can understand what is called derivative. Okay. So derivative is an instrument whose value is derived from the value of one or more underlying. What are the underlying? That is, which can be commodities, metals, currency, bonds, stocks and stock indices. Okay. The four most common examples of derivative instruments are forwards, futures, options and swaps. So we can see in detail what is called this forwards, futures, options and swaps. So now what are the derivative instruments which we are used for trading? Okay. So what is called forwards? It is the customized contract between the two parties to buy or sell an asset or any product or commodity at a predetermined price at the future date. So at future date we are buying. So that is called the buying or selling. So that is called the forwards. It is to be noted that forwards are not traded on any central exchange but over the counter, and they are not standardized to be regulated. Therefore, it is mostly useful for hedging to minimize risk even through it doesn't guarantee any kind of profits, and this forwards is no more in between the selling. Okay, so that is the thing we are explaining here, that forwards are not traded on any central exchange. So what is called futures? So I hope everyone should be aware of futures and options. Okay. The future contract is similar to a forward, but there is one difference, that is, except the deal is made through an organized and regulates exchange. Okay. So there is a SEBI involved in the futures rather than being negotiated directly between the two parties. So in forward, there is no exchange is there. So it is between the two parties. But in futures, there is an exchange involved, okay, between the two parties, that is between the buyers and the sellers. Indeed, we may say futures are exchange traded forward contracts. So till now we have learned what is called forwards and futures. Now we can learn what is called options. So everyone must be aware of options, right? So options is the contract that gives the right but not the obligation to buy or sell the asset. That is the underlying at the stated date and price. And the buyer of the option, what he will do is he will pay the premium for the right. Okay. But the seller of the option receives the premium with the obligation to sell or buy the underlying if the buyer exercises right. Exercise means he is like closing the position. Next is what is called swaps. Swap is an agreement made between two parties to exchange the cash flows in the future according to the pre-arranged formula. Also, swaps helps the market participant to manage the risk associated with volatile interest rates, currency exchange rates and the commodity price. Who are all the market participants? We need to understand these concepts. Okay. So if you are doing options or future trading, we need to understand that who are all the market participants, or what is called forwards or futures and swaps. So the first participants, they are hedgers, second is speculators or traders, and third is arbitrageurs. So we will see in detail about all these three topics. What is called hedging, or who are called hedgers? They already have the risk with the prices of underlying asset and use their derivatives to reduce their risk. So why we do hedging, or why hedging is required in the market? So if we are buying any position thinking like market will go up, but in order to avoid the risk in case if the market falls, we will do hedging. Okay. The main objective is to avoid losses from the positions. The ideal situation in hedging would be to cause one effect to cancel out another. That is it is the risk neutralizing strategy, that there is no risk involved in hedging. Okay. So that is the reason we are using other derivatives to reduce their risk. If we buy any asset or any instrument, in order to avoid the loss, we will be selling the other position in order to reduce the risk. Hedging involves taking an offsetting position in an investment in order to balance any gain and losses in the underlying asset. By taking an opposite position, hedgers are trying to protect themselves against no matter what happens with the prices. So they are trying to protect their profits, and in order to minimize their loss, we will do hedging. We can see an example for hedging. Assume that a company specializes in promoting jewelry and it has major order due in 6 months, one that uses a lot of gold. The company is worried about the volatility of the gold market and believes that gold prices may substantially increase in the near future. So, in order to protect itself from this uncertainty, the company could buy a 6-month future contract in gold. This way, if the gold experiences a 10% price increase, the future contract will lock in a price that will offset this gain. What is called speculators or traders? The speculators, they try to predict the future movements in the price of the underlying asset, and based on the view, they will take the positions in the derivative contract. So speculators is also called as traders. So based on their view, they can enter into the CE or in the PE trade. So they will do more number of trades per day. Okay. So they are called speculators because they will speculate the future price. Next is what is called arbitrageurs. Arbitrageurs produce profit by exploiting a price difference in the product in two different markets. So what is these two different markets? That can be NSE and the BSE. Say they will do buying in the NSE and they can do selling in the BSE. So this is called the two different markets. Okay. Now we can learn what are the terminologies in the derivative market. First is spot price. The price at which an asset trades in the cash market is called spot price. Futures price, the price of the futures contract in the futures market. What is called contract cycle, the period over which a contract trades. What is an expiration day, the day on which a derivative contract ceases to exist. It is the last trading day of the contract. Ticket size, it is the minimum move allowed in the price quotations. Exchanges decided the tick sizes on traded contracts as part of contract specification. What is called basis? The difference between spot price and the future price is called basis. If the futures price is greater than the spot price, basis for the asset is negative. Similarly, if the spot price is greater than futures price, basis for the asset is positive. What is cost of carry? Cost of carry is the relationship between futures price and the spot prices. It measures the storage cost plus the interest that is paid to carry the asset till delivery, less the income earned on asset during the holding period. What is called contract size and contract value? Futures contracts are traded in lots, alright, and to arrive at the contract value, we have to multiply the price with the contract multiplier or lot size or contract size. What is called price band? Price band is essentially the price range within which a contract is permitted to trade during the day. That is called the price band. That particular price is essentially in the price range. What is margin account? An exchange guarantees the settlement of all the trades to protect itself against default by either counterparty. It charges various margins from the brokers. Brokers in turn charge margins from their customers. This is called margin account. What is called initial margin? The amount one needs to deposit in the margin account at the time of entering a future contract is known as initial margin. We all have heard this term MTM, that is marking to market. In futures market, while contracts have maturity of several months, profits and losses are settled on day-to-day basis is called mark to market, MTM settlement. Open interest and volumes traded. And open interest is the total number of contracts outstanding, that is yet to be settled for an underlying asset. This is called open interest and volumes traded. This is my Telegram channel, Trader Chitra, currently having 8,000 plus subscribers. Here I used to share the Nifty and the Bank Nifty levels, that is a support and the resistance level for the next day trading. So I used to share this level every day evening, okay, for the next day. Okay, so today, that is August 31st, I have shared the Nifty resistance at 19,385 at 911. Okay, and after that we can see that market started falling down and Nifty made a low. Nifty was currently going down and Nifty made a low on low till 19,200 for the same day. Here I used to share the live levels. This is the free channel. You can join this channel, those who are doing intraday for Nifty and Bank Nifty. Okay. Hope this video is useful to you. Please don't forget to like, share and subscribe. Click the bell icon too for my upcoming video notifications. Thank you for watching.